Good afternoon. Welcome to another edition of Facebook Live for Spectrum Financial Alliance. It's October 22nd, and we're going to talk about something that we've had quite a few discussions about recently. And so the title of this event is Fear is Your Friend, 2020 Election Consequences on the Markets and Your Investments. You know, I think in a lot of ways for investors, fear is their friend. First, we got to recognize there's no market unless someone's willing to buy and somebody's willing to sell. An undisciplined seller will tend to sell when uncertainty goes up in the market. And one thing we know about life is that there's always going to be uncertainty. Fear of uncertainty causes market flight. Market flight causes the price of equity instruments to go down. And price lowering below what we would compute mathematically as a fair market value creates buying opportunities for our investors. So while most money managers and investors see fear as something to run from in the markets, we look at it as a potential opportunity to buy or own deeply discounted assets at below fair market value. You know, in 2018, there was a period that was around 2.5 months in the last quarter of the year where the market fell over 20%. And this fear was driven almost entirely by what we considered the irrational fear of an interest rate inversion. And an interest rate inversion is a situation where long-term rates are below short-term rates. We correctly wrote at that time that it was theoretically impossible at that time to occur. In hindsight, we were correct. That allowed us to buy into that decline and produce the results you see on the right side of your screen from where we called the market low in a letter to our clients dated December 24th, and that was the market's low, through the end of the next year. The extreme outperformance of over 10 percentage points you see depicted is a consequence, a rational consequence of taking advantage of the fear of irrational investors. Here's an Ibbotson chart that I'd like you just to kind of study for a moment, please. What you see here are 4 different lines, actually 5. Small stocks at the top, that'd be companies of generally less than $1 billion in annual sales. Large company stock returns of 10% even. And this is over a time period depicting 1926 to 2018. So it's starting in the midst of the upcoming depression, and it's ending before the great year of 2019. So these numbers are conservative. Then government bonds, treasury bills, and inflation. Notice that when you look at the green line, treasury bills, which are very short-term, very stable instruments, you're getting a return that's just a hair above the inflation rate. The return on bills is 3.3%, and inflation over those years annualized approximately 2.9%. That means that after income tax, treasury bills generally underperformed the inflation rate. Government bonds had a return of 5.5% during this time. Compare that to large stocks at 10%, nearly twice the return on government bonds. The trade-off for these increased rates of return is what you see in the top 2 lines, where you have times of volatility. And I can assign specific events to those times of volatility. You may remember some as well. But the fact is that volatility, that downside movement, was more than adequately compensated for by the excess returns that accrued over time. So the dollar values you see on the right side of the scale are what $1 invested in first of 1926 would have grown to in nominal dollars today. So fear really is an investor's friend generally. The fact that other investors run during times of uncertainty, primarily by setting what are called stop loss orders, where you say, hey, if this goes down 10%, I want it automatically sold. That's the reason why Dalbar, a very large company that studies investor returns, consistently shows that average investor returns are only half of the normal equity market index returns annually. They run at the wrong times. They buy in when markets are near heights. This market flight destroys a long-term investor's return and drives a pervasive problem, or something I think is really important, and that's over-diversification. Over-diversification occurs when you buy a little bit of everything, not taking a strong position in any element. So you're buying things that would have a tendency in that particular micro or macroeconomic environment to lag. Many times short-term fluctuations create opportunities that our firm attempts to exploit. And in my financial life experience, the greatest rewards our clients have received and our firm has attained have come from taking intelligent, controlled risks. The most successful investors of all time share this philosophy. I'm talking about folks like the father of value investing, Benjamin Graham. I'm talking about Warren Buffett. I'm talking about the greatest mutual fund managers of all time. Our firm is a concentrated and predictive asset style. We are an opportunistic investor. Our returns reflect success because we adhere to our style and we don't allow irrational fears to drive us out of the market. We accept the market's normal ebbs and flows. Folks that won't do that are sacrificing market level returns. This volatility avoidance behavior is the main reason, in our opinion, that Dalbar shows annually that the average investor has what I consider to be very, very mediocre returns that are approximately half those accomplished by our firm's clients. So let's look at those returns. Dalbar studies show anywhere from the mid 4% to mid 5% return for the median client over long periods of time. And the equity market's returns tend to be around 10%, which is approximately where our firm's been on an annual basis over the last 11 years as measured by Morningstar Inc. So let's look at the difference in growth of a $100,000 investment depending on whether you are fully diversified and avoiding market volatility or embracing it. So at 5 years, a 5% return on a $100,000 investment would have grown to $127,628. A 10% return would have grown to $161,051. If you held to 10 years, it's a difference between $259,000 and change and almost $163,000. At 20 years, it's $672,000 and change versus $265,000. And at 30 years, it's $1.7 million compared to $432,000. Folks, these are extremes, and the market is consistent in that it approximates a 10% return long term. The average or the median investor return at 5% or less is mediocre, and it costs clients their financial security and financial freedom. I've had a lot of clients say, "Hey Kelly, am I too old to use growth instruments?" I'd like to answer that question in two ways. One way is just look at the chart here for a second. If you're 60 years old, your life expectancy today as a male is a little over 81 and a half years. Female, 84 and a half years. That means for a male, you've got a little over 21 years, or somewhere between 5 to 7 market cycles. And a market cycle is an up move and a down move. That's one cycle. So the average market cycle is 3 to 5 years historically. You have a lot of time at 60. At 70, for the average male, you'd have 14 years, or approximately 3 cycles. A woman at 70 would have 16 and a half years, approximately 4 to 5 cycles to go. So are we too old? I don't think so. I think temperament is a lot more important than age. The industry is taught that age is the determining factor. That is simply untrue. This was a lesson I learned from a very wise man who's been gone many years now, but it was 1987. I had a 95-year-old client by the name of George Fugit. George was a 4th grade dropout. He was a wonderful man. He was a great man. He was a very intelligent man. And he understood volatility wasn't tied to the ability to accept volatility was not tied to one's age, which led to him accomplishing some great returns with me. In 1987, just prior to what we now know as Black Monday, a day where the market fell 22.5%, I called George and said, "Hey, George, I'd like to lighten up on stocks." George came in to see me. See, George had lived by himself for the last 30 years. His wife died when he was 65. He lived in the same home they owned on Clay's Mill here in Lexington, Kentucky. And George still cut his grass, and he went to 3 Kiwanis Club meetings a week, rode the bus down from the bus stop near his house, walked everywhere he went. Extremely healthy, vigorous man. And George sat down and explained something to me that day. And he asked me this question. He said, "Kelly, are you telling me that if I diversified my account and bought bonds and sold some of these terrible railroad companies I've got that have not gone up in 20 years, and that's the truth, that the bonds would give a better rate of return long-term than stocks?" And I said, "No, sir, they wouldn't." And with fire in his eyes, he said, "Kelly, I am a long-term investor." This was a man at 95. Now, George lived in that house and cut his own grass for 7 more years, nearly 2 market cycles. And then he moved from there to an assisted living facility where he died at 105. George was an extremely financially successful investor and did not believe at age 95 he was too old to invest for the long term. This chart proves that. Now here's the question I wanted to really address clearly because it's come up a lot. Same question we got in 2016 about a Hillary Clinton presidency. Will a Joe Biden presidency tank our portfolio? The answer is clearly no. And if you want to know why, let's just follow the money. Here's a chart from an online service called opensecrets.org, really good service, where you can look up any politician and see where their money's coming from. Please note under Joe Biden in the left column that the securities and investment industry is the number 3 largest donor. Lawyers are the 4th. You see Donald Trump's figures on the right. Now, there's fear and trepidation about whether or not a President Biden would be able to make wholesale changes to our economic structure, take our whole economy to a socialist economy, and cause the stock market to tank for years. I simply believe when you look at this chart and you follow the money and look at who his backers are, you'll realize that is theoretically impossible. The Clintons were to the same degree compromised by their contributors. Contributors determine policy. Here are some holdings we have that I also believe we might want to think about a little bit because actually they would likely benefit from a Biden presidency. First, Boeing. You all might know if you've read some of our social media posts over the last couple of years that Boeing got a severe hammer applied to them by China when President Trump invoked the trade sanctions in the Phase 1 deal with China and prior to that deal. Boeing had very, very large orders canceled from communist-controlled airlines in China. A Biden presidency would reopen that avenue of sale. And Boeing's really important for our country, folks, because it is our single largest seller of manufactured goods overseas. So I think Boeing would probably come out ahead. I know our bank sector would, a sector that has approximately 35 to 40% of our clients' assets in it. And those three top holdings for us are Citigroup, Capital One, and Bank of America. We believe that sector is poised to do some amazing things over the next year and beyond. But under a Biden presidency, with much less controlled spending, long-term rates, which are going to go up anyway, would go up at a much faster rate. This would raise what's called the net interest margin that banks look at to determine their profitability. Net interest is the difference between what they lend at and what they're paying you for deposits, or what they're borrowing funds from the Federal Reserve at, which right now is 0%. So that net interest margin would go up much faster, we believe, in a Biden presidency, therefore accelerating what we believe is extremely strong growth that underlies the entire banking industry. Core Civic is another holding I want to discuss. September and this month to date have not been kind for Core Civic. And I got a call from a really good client yesterday asking why we're holding it. And here's why. Core Civic had a really good second quarter earnings report. They've got another one that comes out in 13 days, just after the election. Core Civic is a company that's in a great financial position, and I'm talking about their balance sheet. Their debt-to-equity ratio is right at 0.56, which is incredibly low debt for a company of that type. They're extremely well managed, headquartered down in Nashville. They just had a contract on a facility that they thought was going to be closed in Cushing, Oklahoma, that houses approximately 1,200 inmates. Had a contract for the U.S. Marshals that came through about a week and a half ago, re-upping that facility. That was totally unanticipated. And yet, in this period of all great news leading up to what I think is going to be a good third quarter, we see the stock dropping by approximately 25%. 8% of that was yesterday. And so you have to ask yourself why. I believe there's two reasons. First, there's a lot of fear about a Biden presidency, and it's believed that private prison companies like Core Civic would be driven out of business. Since the federal government controls less than 10% of Core Civic's revenues, that simply is not true. But it's also theoretically impossible, because if you shut Core Civic down, you're going to be putting thousands and thousands of felons, murderers, rapists, etc., on the streets. We don't have the capacity in our state or federal prison system to house these individuals. And the cost to the taxpayer to build those facilities, which would take years, would be extraordinary. So it's a threat that cannot be carried through. The second reason the Core Civic has declined is the general feeling that private prisons are just so much worse than public prisons. But if you've talked to prisoners in both those type of facilities, and I have, that simply is not true. The iron shield of sovereign immunity is lifted a bit if you're a private prison employee. So private prisons tend to be better places, more humane places for our prisoners, who I think are abused in the American prison system. And I know that's something that President Trump has worked on in this term, and believe it'll be worked on in the second term. Now I want to look at something that's just a broad statistic, but this is equity market movements, Dow Jones, S&P 500 movements, under Democrat and Republican administrations. And what you see here is a clear superiority in stock market returns under Democrat administrations. So again, we would not be hurt in a Democrat administration. Why is this? It's because Democrat administrations tend to spend money much freer, much looser. And that creates a good temporary effect for the market. Long term, as we expand the level of our nation's debt, we're already to a level where our great-grandkids could never repay it, so we have used their charge card even before they're born. But that party's going to come to an end. Republican administrations tend to be tighter fiscally, and it's my belief that that accounts for the disparity in returns. Now let's talk about the 2020 election. Just like market volatility, I do not think the election is anything to fear. The primary reason I feel this way isn't that a President Biden would be better for the markets. It's because I believe that President Trump's election is absolutely already accomplished. The silent majority has spoken loudly at his rallies and at events that have not even been planned by any of his campaigns. You've seen the same enthusiasm and passion that I have if you're watching any network other than CNN or MSNBC. A Biden presidency will slow our economy's growth, and that growth is necessary to provide for our next generation and generations to come. No question about that. But we don't think that's a problem. We think that President Trump will be overwhelmingly reelected. You see, in our country, elections are not determined by the popular vote. A lot of folks think that's unfair, and I understand that. And I can sympathize even with that opinion. But our founding fathers and mothers were very wise, and they set up a system of checks and balances that pervades all three pillars of our government: the judiciary, the legislative branch, and the executive branch. One of the checks and balances they put in was to have an electoral college so that smaller states that are now called flyover territory, were not ruled by a few cities on the coast where we had very large urban areas and where votes could be purchased by politicians through social benefits. For that reason, the Electoral College predominates. The Electoral College last term awarded 302 votes to President Trump. 270 are needed to win. We believe his victory will be by a significantly larger margin this time. We think some of this margin is going to come from minorities, where they've seen President Trump's achievements this term in very uphill battles in gaining sentencing reform that adversely affected minorities in our country, the creation of opportunity zones, which he did with Senator Scott, a black American from South Carolina, and other things that we've done for historically black colleges and other institutions that have made a significant difference, including on the war on poverty, where our lower income Americans' incomes have gone up at 4 times the rate their incomes advanced during the 8 years of the Obama administration. We also believe that candidates who promise tax increases, as Joe Biden has, have a verified 100% history of not being elected or reelected. And Biden is pushing now for the largest tax increase in history. Trump won overwhelmingly on a poll that was done recently by Gallup on are you better off than you were 4 years ago. 56% of Americans responded yes. That question and the question of which candidate aligns more with law and order and national defense have always, in our lifetimes, tended to be the predominant deciders of presidential election. There's also a significant enthusiasm gap among Biden voters and Trump voters. 46% of Biden voters in a recent Pew poll said they strongly support him, compared to 66% of Trump's voters. That's a historic 20 percentage point gap. The election of Biden would not only bring immediate tax increases, which would slow our economy's growth and thereby slow our ability to outgrow our debt issues, but less freedom in our country. Part of the loss of freedom occurs because Biden has already said that foolishly and against the World Health Organization and America's Centers for Disease Control guidance, he would actually shut the economy down again, even though these organizations are saying don't do that. And I'm going to tell you why they're saying that. They're not saying that because they don't think that might save a few lives right now. They're saying that because they know the trade-off in lives lost and our children's futures is much worse than the lives that would be saved. In other words, there's no balancing act there. And even the World Health Organization is realizing this. We have to balance the lives expected to be saved versus the adverse consequences that have already occurred when you shut an economy down. That collateral damage is extreme. It's shown in the increased suicide rate. It's shown in increased cardiovascular incidents. It's shown in increased strokes. It's shown in increased DUIs and imprisonment. The damage is extreme, and we've got to stop. If the cure is killing more people than the illness, stop the cure. With a likely emergency authorization of vaccines and therapies coming out over the next month or so, we believe that the percentage of Americans saying, and it's 56%, that they're better off now than they were 4 years ago will continue to rise sharply. So I want to summarize what we've talked about. Fear is your friend in the investment world. It's not your enemy. We need to use those opportunities where fear is overblown, and it's not always overblown. We make that judgment on a daily basis. We need to use those opportunities and capitalize on them. In life, people of faith would say that things always have a way of working out. And that has certainly been my experience in my life. During periods of high fear, people unthinkingly flee. But staying involved has allowed great success, and it's allowed our returns to excel. Full listing of all disclosures is available here at this link if you'd like to look at them. I would invite you to call in or email us if you have any questions that I haven't addressed. And I want to say on this Thursday, I hope the upcoming weekend is wonderful for you and your families. We look forward to an outstanding last 2 months of this year and believe strongly as we look over the next 4 or 5 years that great economic and investment success lies ahead. So God bless you and God bless our country.